Interest rates today are at historic lows, but should you really refinance? Is it actually going to save you enough to justify the added closing costs? We're going to show you how you can get a definitive answer to the refinance question for your unique situation. Coming up. If this is your first time here, welcome to the channel. My name is Steven Spicer and it's my goal to help you plan and invest smarter. Now in this video, I want to go over the considerations that need to be taken in order to thoroughly evaluate if refinancing is in your best interest. I'll go through an exact scenario that we ran into with one of our clients and talk through the options we considered and how we determined the break-even points with our own special calculator. And finally, if you hang out with me until the end, I'll show you how to get access to that refinance calculator so that you can use it to effortlessly run your own numbers. Now, the first step in determining whether you should make a change and refinance your home or property requires an awareness of where you are today and what the better alternative or alternatives could look like. This should probably go without saying, but most often the primary reason why refinancing makes sense is because a lender is willing to lower your interest rate if you do so. Now, they may have already approached you and offered this lower rate, or you may have to go ask yourself, but this is the basis of where most are starting here. If you are indeed offered a lower interest rate for refinancing, try to gather as much information on all the different offers as possible. The things that you'll need to get are interest rate, minimum payment, length of the new mortgage, and closing cost. And these variables will change depending on that length of the new proposed mortgages. The most common offers are for 15-year and 30-year mortgages. However, what a lot of people don't realize is that often lenders will allow you to set the length of time to whatever you desire. If you only have 20 years left on your mortgage, don't hesitate to ask what they would offer you to maintain your 20-year mortgage and just refinance at that lower rate. Now, it's almost always the case that the shorter the length of time that you're borrowing, the lower the offered interest rate will be. At the same time, the same principal mortgage balance crammed into less years will result in higher minimum payments. So you have to find the right balance for you. Some of the most complicated factors we consider for our clients when helping them come to an educated conclusion here include break-even point. When will the closing cost of your refinance have paid for itself given the lower interest rate? Do you plan on keeping this property past the point in which you would break even? Then there's the payoff speed. If you continue to pay the same amount that you are today, will you end up paying off your mortgage faster? But maybe you have no intention of continuing to make that same payment, that same now elevated payment. Maybe instead you need to know how this decision will impact your cash flow. If you refinance your home and extend the mortgage length, do you gain a significant cash flow increase that could be better utilized, either by investing that difference or by using it to pay off some higher interest debt? And sometimes it may even make sense to consider a cash out refinance. Could you pull equity out of your home, get a lower interest rate in the process, pay off higher interest rate debts, for example, and lower your total overall minimum payments across all your debts by doing so? Clearly, when determining whether or not to refinance, there can be a lot more to consider than just whether or not you're able to lock in a lower rate. When trying to confidently answer these questions for our clients, we found ourselves going back and forth between various online mortgage calculators and Excel. And given how often we're dealing with questions like this, I was so grateful when one of the partners on our team took the initiative to create one comprehensive spreadsheet to rule them all. It pulls together these variables and key decision-making factors into something that's easy to read and evaluate, saving us and our clients a ton of time, especially our clients with growing real estate portfolios. They're dealing with these considerations all the time. Now, I want to take you through the numbers of a client that we worked with recently, helping them understand which decision would make the most sense given all of the variables they had in play. Okay, so like I said, the first thing we had to do was determine where they were. So here's the calculator that we use. I'm going to show you exactly how to use and what to look for with the numbers of our client, and then tell you how you can get access to this tool for yourself. Now, they had $236,092.81 left on the mortgage. And then that was originally put on a 30-year schedule at a 5.375 interest rate. And they weren't quite sure how many months they had left on their mortgage. but they knew that their minimum payment of just the principal and interest was $1,455.93 each month, and that they had been paying exactly $2,000 onto their mortgage each month. Now we can see that given their current balance, current minimum payments, and interest rate, that they had just over 24 years left on this mortgage. Now you can also see that an error comes up here because the actual total payment amount is still set at $0. So when we apply the actual payment that they've been making of $2,000 each month, we see that $544.07 that is extra that they've been putting towards their mortgage, which reduces the time frame to 14 years exactly. Now, if you aren't paying any extra, then just retype that same amount here because it's used in comparison for different scenarios. Now, they got information from their mortgage lender for a 15-year and a 30-year refinance option. For that 15-year option, their new interest rate would drop to 3.5%. We'll go ahead and put that in here for scenario 1. The renewed 30-year option, on the other hand, would have a 3.75%. In both cases, they will incur a $6,000 closing cost. Now, all you have to do here is type in that closing cost because it's pulling from the original numbers that you have typed in for your current mortgage. If you do decide you want to manipulate it in some way, keep in mind that it is simply adding the closing cost in these cells to the mortgage that you typed in over here. Okay, so as I typed in that information into the scenarios, some numbers were generated below. So let's go through what all this means and then tinker with some of the numbers. One of the most important things to note in scenario 1 is that by refinancing to a 15-year mortgage, the required minimum payment increased. Now, because they're accustomed to the $2,000 a month payment on their mortgage, this is okay for them. They can obviously afford it. In fact, they would still have $269.32 as an extra payment going straight toward paying down their mortgage's principal each month. Now, this would result in a payoff of 12.42 years, which is faster than their current 14-year timeline. Additionally, they would break even on their $6,000 of closing cost in just 1.58 years. In other words, in just about every year and a half, they're saving $6,000 worth of interest with this refinance option, resulting in a total savings over the course of the 12.42 years of more than $40,000. Now, this break-even is important, especially for this client, because there's a good chance that they'll be moving within the next couple of years. All of that's important to keep in mind as you weigh your options. Now, when you look below, you'll see a section that's focused on cash flow. And based on the scenario, this client would still have that $269.32 of additional cash flow if they dropped down to their minimum payment. Now, in this case, they'd be keeping all of that extra cash flow in this scenario that we're outlining here, not putting any additional towards the principal each month like they currently are and like is illustrated at the top part. Now, given that, it might surprise you to see that even with an extra year of payments, right, that new 15-year mortgage instead of the 14-year payoff date from before, they would still save more than $30,000 on the total cost of their mortgage in comparison to what they're currently doing. All right, let's jump over quickly and take a look at scenario 2. The new minimum payment is considerably less than the 15-year option, more than $600 per month less. But even while using that $2,000 per month as the total payment, it still doesn't have as fast of a payoff at 12.67 years, simply because the interest rate is a touch higher. The break-even point still happens within the first 2 years, and the interest savings is still very significant. But from a cash flow perspective, that's where the big difference is. This client would have $878.83 each month that they could allocate elsewhere if it made sense to. You can compare this cash flow part to the payment flexibility that you would have with your current extra payment that you're making each month. So in this case, they would go from that current $544 each month of cash flow to the $269 that they'd have with that 15-year option, or the $879 that they'd have here. So much more flexibility with this option for emergencies, for example, while only taking a couple of months longer to fully pay off the mortgage. Now, if they chose to refinance this back out to 30 years and only make minimum payments, even though their payment would be less, they would be adding 16 years onto their mortgage, which would result in more interest paid to the tune of over $60,000 extra. Now, this sounds horrible, but considering that $878.83 is freed up each month, it may have the potential over 30 years to accomplish much more than the $60,000 of interest savings. As with many of these financial decisions that we cover here on this channel, it'll just depend on you and your unique goals and circumstances as to which option here might make the most sense. Now, the last thing that a lot of people enjoy doing is experimenting with the numbers. For each scenario, there is a calculator at the bottom that allows you to play with the total payment that you choose to make each month to see the potential impact. For example, what if on the 30-year option, they wanted to pay what their minimum is currently with their existing mortgage at $1,455.93, and they wanted to compare that to just making the minimum payment on their current mortgage. So if we change it down here in the customizable section, it will still be compared to the $2,000 of the current payments on the mortgage. By changing it with the current mortgage as well, so you can see that by making the exact same payment on both mortgages, that the 30-year refinance option would pay off the mortgage over 4 years quicker, saving more than $80,000. Not to mention that if you get in a crunch financially, you would have the option to drop down the $1,455 payment to $1,121. The ways in which you can experiment with the numbers here are endless. If you're into that type of thing, have at it. Guys, I know that if people were simply equipped with the ability to get this type of pertinent information, that they could approach opportunities like refinancing their mortgage with confidence, saving themselves thousands of dollars and years of being in debt. I'll put a link to it in the description where you can get access to the calculator that I just used. I hope this video helped out. Thanks so much for watching, and until next time, take care.